Hello, everyone. My name is Nathan Kolb. Thank you for joining us for another Credit Safe webinar. I want to welcome you today and want to just kind of give you a little bit of an introduction on how this all works and how we do our webinars. So first and foremost, we want you to be able to talk with us, go back and forth with us, and have a discussion here, really more so than just the normal presentation type thing. So what we do for that is we have a Q&A button at the bottom of the screen. You go right ahead, put your stuff in there, type your questions, ask them as you have them, and I will make sure to go ahead and ask these to our guests today. It's something I'll be monitoring the entire time. If you have a comment, something to add to the discussion, please go right ahead and do that. We may not get to it right that moment, but at least it's there and you haven't forgotten it, and we can roll on with it, which is great. Also, I want to let you know that this is being recorded. This is a recorded webinar, which means two things. One, if that's against the privacy policy for you or your company or something like that, please go ahead and exit the webinar now. But if you can stay with us, then you're going to be able to ask the questions and stuff like that and get a recording afterwards of this entire webinar. So you don't need to take notes right now or anything like that. You will send you a recording here with a follow-up email within a couple of days, and you'll get all of that included. All right, so now that we've got all that type of stuff out of the way, we're going to go in and start talking about what's going on today. So today's topic in general was part of a two-part series here on managing the demand for credit. With COVID changing everything and all of that, there's been an uptick, a massive uptick in the demand for credit, and it's changed what is being demanded and stuff like that. Today, we are specifically looking at credit insurance. And how that plays a role in this. We were looking at opportunity and risk last time, and you can find that on our website. You'll get, I'll tell you about that at the end and all of that. But now we're going to be talking more specifically this time about credit insurance. And once again, I'm pleased to introduce and welcome Gary Mendel. He is the president of Meridian Finance Group, a company which provides credit insurance and trade finance tools that companies use to expand their U.S. and international sales. Gary specifically has over 40 years of experience in domestic and international sales, distribution, credit, and finance. Prior to Meridian, he held positions managing U.S. and export business development for companies in the pharmaceutical, aerospace, and plastics industries. Gary has received the President's E for Export Award and currently serves on the federal government's Trade Finance Advisory Council. Wanted to make sure I got that one right. So Gary, welcome. It's great to have you yet again.
It's a pleasure to be here.
Awesome. So I'm going to let you take over at this point. You are the expert here, and we're going to let you kind of run the show here. I know you have a presentation for us that folks can ask questions as we go, and then we'll just be rocking and rolling here.
Okay, let me just pull up the slideshow and we'll get started.
So, and as you're doing that, folks, if you are looking for last time, if you want to go back and do that, we are going to do a quick recap here. Gary's going to do that for us. But if you want to go forward or going forward, if you want to watch that later at your convenience, all you can do is go to creditsafe.com/webinars. And you just scroll down a little bit, it'll show all the recorded webinars that we've ever done. We have about one a week. So by the end of the year, we'll have about 52 of them that have just been for 2020. So go ahead and look at any of them, but you can find the earlier one that Gary did that is the preface to this one. So Gary, take it away.
Hi, everybody. Thanks for tuning in. Let me go ahead and start down the slides here. What I'm going to start by doing is just a quick recap of what we talked about last week, because it sets the stage for today's conversation. Demand for credit, when customers are looking for longer payment terms and bigger amounts of lines from their suppliers, has been going on for a long time, well before the outbreak of the pandemic. But demand for credit, as Nathan said, has surged since the beginning of the coronavirus time. Companies are facing limited access to working capital from more conventional sources, from banks and lenders and other financial institutions, and possibly from other suppliers. So they're looking to you as a supplier to essentially provide them with working capital by providing longer payment terms, bigger amounts of lines, and other consideration. You also may have found in COVID time that you want to extend more credit, both so you can keep doing business, keep winning orders amidst the challenges, as well as keep yourself ahead of your other competitors that are still out there. One of the big things we've seen amongst our clients has been the challenge of getting distributors to keep taking inventory. The challenges here are arising not necessarily in sectors that are doing poorly, because sectors that are doing poorly, companies are not really buying anymore. It's the sectors that are doing well, but where there are logistic and supply chain and other challenges, like I was just describing, where distributors have really pulled back on stocking inventory, which has put a lot of pressure on suppliers to maintain a lot of stock, and maintaining inventory is expensive. And so really what you want to do is continue what you always have done, is getting your distributors to take, to place orders and to have a certain stocking profile so that you transfer your inventory carrying costs from yourself to your distributors downstream in the supply chain. The only way to do that today is to offer them more credit and longer terms, longer amount of time to pay. The other benefit of that, of course, is your product gets closer to the end users, and staging product closer to end users in these times of compromised logistics is another real plus. So there's both demand from your customers for more credit, and there are your own strategic reasons proactively for trying to give more payment terms to customers. Once you cross that Rubicon, though, and start opening up more credit, the challenge is, twofold. One set of challenges has to do with the risks of not getting paid, the other with working capital. On the non-payment side, again, non-payment risks have always existed when you extend open account payment terms to customers, but those have been magnified in COVID time. Again, because of cash flow reasons, because of balance sheet reasons, companies, customers becoming more leveraged, not having as much flexibility in their financial situation, so that if anything unanticipated happens, they may not have as much flexibility to be able to turn around and pay you as timely. Payment morality has certainly slipped. There are also the impacts of the coronavirus itself. And this is one of the things to look out for, is while plenty of companies are paying slow or failing to pay directly because of the pandemic and its impacts, other companies are using it as an excuse, and it may mask underlying shortcomings or deficiencies in the creditworthiness of a customer or how they're paying. And one thing you want to be careful of as a supplier or a creditor is not going into each situation assuming that the reason a customer is paying slow or is having an issue is because of the pandemic and its economic impacts. Because again, if you look at everything through that lens, you may miss other underlying issues which you'd want to be able to recognize in order to deal with them most directly. Beyond the non-payment risk, there are also the working capital challenges. And there's really sort of three things combining to make that the issue. Number one, payment terms have gotten longer. Net 90 is the new net 30. Companies are insisting on longer payment terms, and they need longer payment terms. So companies you were invoicing on 30 days before might be at 60 or 90. In some cases, we're seeing 120 and even 180-day payment terms, which you have to make a decision about whether you're going to do that to hold on to the business or to compete or not. The second factor is companies paying slow, whether it's because of the pandemic, whether it's because of a slipping payment morality, whether it's because of cash flow issues on your customer's part or them waiting to get paid by their customers. Companies are paying slower. Even if the current situation continues for another year or who knows how long, throughout that whole period, you may have a customer or all your customers who always end up paying you. None of them ever default, but they always pay you slow during this period. So if you're giving customers 60 days payment terms on your invoices and they're paying you 60 days slow, that means you're not getting your money for 120 days. And unless you've got a heck of a lot of working capital, how are you going to keep fulfilling new orders, paying your workers, paying the light bill, etc.? And so you've got both these non-payment risk challenges and working capital challenges. And now we're going to talk about how credit insurance can help in terms of both of those, in terms of helping you continue to manage credit and continue doing business during COVID time, which, I don't have a crystal ball any better than anybody else, but it's looking like we're going to be in this for much of 2021. If not the coronavirus human issues, then certainly the economic impacts. So to review the basics, because I don't want to spend a lot of time on credit insurance 101, we can, if you're not familiar with credit insurance, we can go over that offline individually. So the assumption here is there's some awareness about credit insurance, and what I'm going to want to talk about is best practices for using it and making it work for you in COVID time. What credit insurance is it's an insurance policy that protects accounts receivable against not getting paid. If a customer who is covered under an insured supplier's policy defaults, and then that debt cannot be collected, the insured party can file a claim and get indemnified under the policy. So credit insurance not only helps companies sleep at night by giving them confidence that one way or another they're going to get paid, it enables them to extend competitive payment terms to their customers and thereby continue selling even during the economic downturn. The insurance increases the profitability of companies' sales, for example, by transferring inventory carrying costs, as I described earlier. And it enables companies to borrow or to enhance their borrowing capacity by being able to include their receivables or more of their receivables in their borrowing base, as well as negotiating more attractive advance rates and other terms with lenders. Because increasingly in COVID time, without insurance, banks and other asset-based lenders are becoming more and more resistant to financing receivables, especially when the receivables are bearing longer payment terms. Some are being paid slow. There are greater concentrations of risk, and so on. When those receivables are insured, banks and other lenders are much more likely to step up. Credit insurance policies can be written on a company's wholesale turnover, on just their key largest buyers, or some other reasonable spread of risk. Is it possible to get coverage on just one customer or even just one sale? Yes, it is, but that better be a really strong creditworthy company. Otherwise, you're going to need to rely on having that company included in a spread of risk of a number of different customers in order for an underwriter to step up. The cost of insurance is low. It's a fraction of a percent of the insured invoice amounts, meaning pennies per $100 invoiced. Claims under a credit insurance policy can be filed and should be filed as soon as possible if the reason a customer didn't pay is because they filed bankruptcy or otherwise went out of business or became insolvent or got liquidated. You don't have any reason really not to. For slow pays from companies that are still in business, most policies, or really all policies, allow a flexible window of time for you to file a claim in case you'd want to try and work things out with your customer instead of bringing the hammer down right away. The policy would allow a period of months of time, should you choose to avail yourself of that, before you would need to file a claim. And under a credit insurance policy, clearly each customer that you're selling to on credit needs to be approved, but it doesn't necessarily mean that the insurance company has to look over your shoulder at every single customer you sell to and bless the credit limit you're giving. Many insurance companies want to take a look at your credit procedures, how you do business, what your track record is, and give you the ability to be insured while continuing to make most or maybe even all of your own credit decisions. So policies vary in terms of how much the insurance company is going to approve your customers and how much you are. Credit insurance comes from a growing number of insurance companies in the US. When I first started brokering credit insurance 27 years ago, there were maybe 4 insurers in the market. Now there's close to 30. You've got multi-line carriers like, that have all different insurance lines like AIG, Chubb, Hartford, Allied, Zurich. You've got specialty insurers that have multiple lines, but they're all specialty lines like surety and so on. These include Great American, Houston Commercial Casualty, Liberty Mutual, etc. There are what are called monoline underwriters that only write credit insurance policies. Names like Euler, Coface, and Atradius. These are large European-based insurers that have been in the U.S. for many years. And then there are some newcomers as well, like Receivassure. Every large economy in the world, the 70, 80 largest economies in the world, their governments have an export credit agency that steps in when the private sector won't to help support exporters with credit insurance and other similar tools. In the US, our export credit agency is Ex-Im Bank. And then you've got another several dozen Lloyd's of London syndicates that write credit insurance, and more of these are available in the US now. At Meridian, we're a broker specializing in credit insurance with offices around the world. So we work with every one of these insurance companies on behalf of prospects and clients. So to review, before we get into the meat of this, the credit insurance is a tool. It's a risk management tool that protects AR against non-payment. It's a sales tool that helps you offer competitive payment terms and thereby make more sales. And it's a financing tool that can maximize your borrowing base, help you monetize your accounts receivable, and negotiate more favorable advance rates with lenders. So what's happening in the credit insurance industry now that we're honestly, closer to 8 months into COVID time? Many more US companies are obtaining the coverage. You know, credit insurance is utilized much more extensively in England, France, Germany, Asian countries, and so on than it is in the US. But now with the significant growth in demand in COVID time in the US is beginning to catch up as more companies obtain coverage here. The level of claims is still holding at about where it has since the end of the last recession, since about 2010. Insurance companies are receiving claims, they're paying them normally in COVID time. We haven't seen any change in how insurance companies are honoring claims, and there have been no special force majeure defenses against paying claims. So this is all a good sign. However, there's a real concern about a surge in claims coming in first quarter, second quarter of next year. Early in the pandemic, insurance companies started liberalizing their policy terms to allow for longer claim filing deadlines, et cetera, to try and be more flexible. Now the usual terms and conditions have returned in most insurance companies' policies because they recognize that the recession is not going to be, a short few months kind of thing, but rather something which extends, potentially beyond the end of 2021 into 22, maybe even further. And so they're hewing to their more conventional terms. Doesn't mean that on a case-by-case basis it can't be flexible, and we'll look at some of that going into some subsequent slides. The big thing to recognize is that credit insurance, once a buyer's market, has now become very much a seller's market. Insurance companies are still underwriting and booking policies, but they're very cautious. And it's unknown how much longer policies will keep being issued, hopefully for the duration. We haven't seen any signs of insurance companies not wanting to write policies anymore, but capacity is definitely tightening on the underwriting side. So if you're thinking about coverage, this will be a good time to get it in gear and start to apply. So what are the best practices now for getting insurance companies to step up and give you quotes and to issue you a policy? Number one, come into the insurance companies with an equitable spread of risk in mind. Trying to cover all of your sales, or at least all of your largest customers. Coming in trying to cherry pick now, saying, I'm only really worried, out of my 20 customers, I'm only worried about these 3 because this one's been in the newspapers having troubles, and this one, their financial statement's not looking very good at this point, and so on. Cherry picking like that, or what's called adverse selection, is not something insurance companies are eager to see. Now, again, if you have a very large customer, a very large creditworthy company, but you're concerned about the exposure, that's something you can still buy a single buyer policy on. And we're seeing a lot more of that. You may have a very low, we have one client who has a $20 million limit on some overseas subsidiaries of Hewlett Packard. They don't have the policy because they think Hewlett Packard is going to go out of business. They have the policy because they could not withstand a loss of that magnitude. It's catastrophic coverage. The second best practice is to include with a policy application a cogent cover memo. Used to be you could just throw a bunch of customer names and credit limits you want at an insurance company and say, hey, would you cover this for me? That's not going to work today. Insurance companies want to make intelligent decisions. They want to know who they're partnering up with. More than ever, they're viewing their insureds as partners, because it's the insured who every day is making credit decisions, who to ship to and how much credit to grant them, behind that insurance policy. So a cover memo does not need to be a book. It can be just a few paragraphs, but something describing the impact of the coronavirus on your company, on the sector you're in, clear explanations for any of your past due accounts and the likelihood of recovering, and descriptions of your credit procedures, especially if they're particularly favorable. And it's important to have reasonable expectations, to show the insurer, to express to the insurer you have a willingness to share risk. You're not looking for them to take everything off of you, but rather put you in a position where you're not on your own in terms of dealing with the exposure. What to expect now when you do get policy quotations? More risk sharing, like I said. Policies that didn't have deductibles have them now. Policies that had deductibles have a little bit higher deductibles now. These are annual deductibles, not per customer. So a policy might say, the first X amount of loss per year is not covered. Then from there on, you're covered at a certain percentage. Those percentages are in some cases also changing. Most policies are still at 90% or 95% coverage. But in some cases, if an insurer is on the fence about your business or about your portfolio, they may come back and say 85% coverage or 80% coverage. Yes, that's not what you were looking for, but getting 80% coverage is better than flying with no coverage at all. Premium rates are going up, but they are still really low compared to the benefits of a policy. Rates are primarily still less than 1% of invoice amounts. Buyer credit limits being approved under a policy. There are two different types of credit limit approvals under credit insurance policies: non-cancelable limits and cancelable. In a cancelable limit, the insurer can come to you and say at any point, look, all new shipments after 30 days from now are not going to be covered anymore to this particular customer. Obviously, anything you'd already shipped remains covered. Non-cancelable limits, the insurer cannot take them away. As long as you are continuing to be paid okay by a customer, you can keep doing business with them. Ideally, what you want to do is to have non-cancelable limits where you can, and those are still available in some cases. But if the only limits you can get are non-cancelable ones, then that's something you should go with, because you should take whatever coverage you can get and enjoy the benefits of having the coverage for the next 3 months, 6 months, or whatever, as long as you possibly can keep being covered. For getting buyer limits underwritten, there are also some best practices. For named buyers, where you're coming in and asking the insurance company to underwrite for you, the credit information that you provide should be as comprehensive as possible. The financial statements, credit reports on the company, trade references from other suppliers, etc., your own ledger experience. And again, a credit memorandum makes a big difference in terms of your ability to get credit approved, your history with the customer, and of course, the pandemic's impact on your customer and on their industry that they're in. Transaction information also. How essential is your product to the customer? Is this a one-off sale, or is this going to be ongoing repetitive business? What kind of leverage you have to push the customer to pay you, and so on. If you can get discretionary credit limits, you want to. This is what I described earlier, where the insurance company will give you the pen for you to be able to make your own credit decisions. And then, this is a powerful tool that enables you to get insurance on terms you extend on the basis of your own credit analysis or just the basis of your own ledger history, the fact that the customer has been paying you well up till now. Sometimes a discretionary credit limit comes at the cost of a higher deductible, but it's worth that cost to have the flexibility to keep doing business based on your own credit experience with your customers. Next, I want to talk about making sure you get indemnified under a credit insurance policy. Credit insurance policies work as advertised. Credit insurance companies pay their claims when you're in compliance with policy terms and conditions. And this is the most important thing. It's not difficult to comply with a policy, but policy credit insurance does have more moving parts than other kinds of insurance, and it's important to understand those, which we'll talk about. First of all, you need to file a claim within a policy's claim filing window. Like I said before, a claim filing window under most policies could be 6 months, could be 8 months. I mean, there's a lot of time available for you to work things out with your customer if you want to before you'd have to file a claim. Of course, you can file much sooner than that. Waiting periods and deadlines are clearly defined in credit insurance policies, and you can approach an insurance company for an extension. You can come and say, look, I know I'm getting close to the end of my claim filing window, but I still think this customer is going to pay. Here's why. And can I get an extra 90 days before I have to bring the hammer down? Insurance companies will look at that story and may well go along with that. They don't want a claim to be filed either, so they'll try and work with you. But you do need to come in before the claim filing window is over. You can't come in 2 days later and ask for that. When you have a loss, a customer defaults and you have a bad payment loss, you need to have a dialogue with the insurance company. You need to make them aware, and you and or the insurance company are going to be in control of trying to collect at that point. It's important to know who's got the ball. The easiest way to do that is to have a dialogue with the insurance company right from the outset. Insurance policies have a threshold of what you have to report. They will say something like, any bad debt you have that is more than X number of days past due and more than X number of dollars past due, you need to report and make the insurance company aware if you haven't filed a claim yet. But beyond that, like I'm saying here, it's a good idea to have a dialogue with the insurance company and collaborate with them. What you have to do is you have to cooperate with what the insurance company wants and do everything possible to minimize the loss. You need to treat the insurance company's money as if it was your money. And one thing you need to not do is accelerate or reschedule any of your debt. Without the insurance company's go-ahead. If a customer comes to you and says, look, I'm not going to pay you timely, what I'd like to do is give you a promissory note saying I'm going to pay you, X amount of dollars every month over the next 6 months to settle the balance. That may turn out to be a reasonable way to go, and you may be okay with that, but that's changing the payment terms you'd originally agreed upon. And so what you need to do is to go to the insurance company and talk to them about it and get their thumbs up before before agreeing to that with the customer. When you do file a claim, every policy has a claim form, and there's various other requirements that insurers have. None of it will be surprising. And at that point, that's where you share with the insurance company your copy of your contracts with your customer, if you have any, purchase orders, invoices, and so on. Because what the insurer is going to do is they're going to put your policy on one side of their desk, and they're going to put the claim documents on the other side and look at them to see that they comply with each other. At the point where the insurance company is about to pay you on the claim, then you sign a release assigning over the receivables to the insurance company, because they're going to try and go get made whole. One of the things to always remember about this kind of insurance that makes it different from other forms of insurance is that it's one of the premises is that the insurance company has the potential to get made whole by going and collecting, and insurance companies have a good track record of recovering after having paid claims. So this is different from most other kinds of insurance. With homeowners insurance, if a house burns down, there's zero scenarios under which the house is going to unburn down. The insurance company just has to take the loss. Whereas with credit insurance, there is this a reasonable possibility of recovery that the insurance company is relying upon. So to review, getting credit insurance claims paid is a function of complying with a policy. While credit insurance policies have more moving parts than fire insurance and general liability and auto insurance and so on, a policy document is no greater than the sum of its parts. These are not 100-page long policies. They're 6 pages, 8 pages. And then of course you've got the endorsements and the declarations and so on, but they're manageable and they're understandable. Your job, unlike other kinds of insurance policies you get that you just stick in a drawer, is to read the policy and get answers for anything you don't understand. Everything should be and can be comprehensible. And then to go about doing business in compliance with all policy terms and conditions, which again should not be a great leap for your company because most of a policy's terms and conditions are consistent with cogent credit practices anyway. And if you follow one guiding principle, you'll be most of the way there, which is to continue extending credit to customers with as much care as if you would do as if you didn't have an insurance policy. Thank you for listening. And now I'd be happy to take any questions or to hear comments about how you're doing, in your sector and so on.
Yeah, I don't see any comments right now on any of that. Maybe we'll get them now that you've said that, but we do have a few questions. And just like last time, they kind of came in, and what I'm going to do is just mix them up a little bit. So folks, if I don't fully ask your question or you wanted to ask another, whatever, there's no limit. And if for some reason I'm not clarifying your stuff right or saying it right, please go ahead and just shoot me a message and re-ask the question or what have you. So I'm just going to kind of go through a bunch of these, Gary. First one, really straightforward as far as I can tell. Is there a reason to go with the monoline insurer versus any of the other types you mentioned? So you said those are the companies, as far as I remember, that are specifically just looking at credit insurance. That's all they do. Is there a reason to go with them over some of the others?
None whatsoever. What you're looking for is the policy coverages, the coverage percentage, as much flexibility for you as possible, getting the credit limits approved on your customer, and as few of the downsides, meaning you want the lowest cost, you want the lowest deductible, and so on, as you can get under a policy. So the whichever insurance company is going to, come in with the most competitive quote for your requirements is the way to go. Now, those three companies, the companies that are monoline carriers, many of their policies come with cancelable limits. Most of the other insurers have non-cancelable limits, and that can be a big one. If you get two quotes that are similar in price and similar in coverage, one of them cannot cancel your limits, including because of COVID time. Companies that had a policy in place, starting from January of this year, say, they still have coverage now. Some of the companies with policies with cancelable limits, those limits have been withdrawn. But that's not a function of the insurance companies. Also, all of these insurance companies are A-rated by Moody's, S&P, AM Best, and so on. So there's not a ratings reason to favor one insurer over another. So it's really not about which company. You should be agnostic about that. It's who's going to come in with the terms and conditions and so on that make, and the buyer underwriting. That's the biggest thing right now in COVID time is, will they underwrite your customers? We'll see 2 or 3 quotes come in now with similar prices and similar coverage. But one insurance company will say, out of your 10 customers, we can approve 8 of them right out of the gate. Another insurance company will say, well, we can only get our hands around 2 of them. Well, clearly you should go with the first. Yeah,
no, that makes perfect sense, and I hope that answered your question. You just mentioned cancelable limits, and we actually have a question about that. Are cancelable limits ever converted to non-cancelable?
Well, they don't really convert. It's more a matter of it's generally more how the policy is set up in the first place.
Gotcha.
Generally, a policy will have non-cancelable limits or cancelable limits. Some of the insurance companies that primarily have cancelable limits, if you have some really big customers in the mix, really strong ones, they may give you non-cancelable limits for those. Generally speaking, I wouldn't say 100% of the time, because there are some cases where cancelable limits might be favorable, but the majority of the time, our clients tend to prefer having the non-cancelable limits because, again, when something like COVID hits, if you're still managing to do okay with your customers, you wouldn't want a third party to come in and unceremoniously say, well, we're not going to cover this anymore, because that can both impact your willingness and ability to keep selling. And if you're using the coverage for bank financing, it could also impact your borrowing base if you now don't have coverage on some of the receivables that made that up. But again, today in COVID time, when we go out to 10 insurance companies, it's not that we're going to end up with getting 7 or 8 quotes. Sometimes we go to 10 insurance companies and get only 1 quote. And if that's a cancelable policy, that's going to be the thing to go with, and do everything you can, and we can help to keep those buyer credit limits you got approved from being canceled.
Right. Makes total sense. So this is a question of legalities. Is there a difference in the legalities based on the state for when and how a claim can be filed?
If they're talking about which state in the United States, yes, but it's not significant. There are different, in the United States. It's funny. We're owned at Meridian. We're owned by a UK company where they just have one set of regulations to deal with. Here we have 50, and they don't understand that that's really a challenge. we have licenses in our company. We have licenses in 50 states, plus DC and Puerto Rico and so on. And yes, there are differences, but they're too minor to think about in the context of whether to get a policy or not, or which policy to get. And the rules apply less to when claims can be filed and more to recourse that a company has to an insurer, that kind of thing.
Okay. You got this here. How likely are discretionary limits for an established company with a full credit policy and a strong repayment history?
I would say they're high. Look, the reason for discretionary credit limits isn't just to give you the flexibility to make your own credit or keep making your own credit decisions. It's also for the insurance company. They don't have armies of people sitting around waiting to underwrite your limits. If a company comes to us and they have just 3 debtors they need covered, well, those are just going to get underwritten by name and listed in endorsements of the policy. If you got 300 customers and more all the time, likely this is going to be a policy that has a discretionary credit limit in it. So, if you've got a well-established credit department and a good track record and all that, it's highly likely a policy would include a discretionary credit limit, unless, of course, you only have a handful of buyers. It might not be needed. We have plenty of clients who don't have a particularly well-wrought credit department. They may be a smaller business. They may be, there may be other reasons they don't have a large credit department. But if they have a good track record, they're in an industry that's not particularly troubled or that's doing well at the moment and so on, they could also get a discretionary credit limit. So it's not something super difficult to get if there's good reason. But if there's not good reason, an insurer is not going to cut it loose, because it is giving you the pen basically to commit the insurance company without them seeing who that customer is or those customers are.
Sure. And they've got a follow-up to this one. Is there any limit to the number of accounts that an insurer will underwrite?
No, but in principle, no. But it all comes down to cost benefit to the insurance company. Some insurance companies have an online database of companies, as many as like tens of millions of companies around the world that they have data on already, and they will underwrite them algorithmically. The upside of that is they don't care how many you send, because they don't have to dedicate people resources to it. You can go into an online platform and just put in, this customer, I'd like to give them a credit limit of $100,000 on 60-day terms, may I? And the system could just spit something out back to you. There's upsides to that, obviously. The downside is who you are, how you do business with that customer, what your track record is, all the things I just talked about in terms of the other factors that you bring to the table that make it a good bet for you to keep giving them credit, even though maybe their financials don't look that good or other things, but you do fine with them, and there's good reason to be confident in your business with them. That those factors don't come into play in that kind of algorithmic process that I just described. Whereas insurers who will give discretionary credit limits, they are looking more at you and your procedures and how you do business and cutting you loose. And so in that case, those insurance companies wouldn't want to look at hundreds of individual debtors. They would want to give you and want you to be able to take on the discretion of making your own credit decisions. And at that point, it doesn't matter. If you sell using your discretionary credit limit, if you sell to 1,000 companies, you can make all those credit decisions yourself. But it all comes down to dollars. If you had a policy where you were paying $500,000 of premium and you wanted to send 100 customers in to get underwritten, the insurance companies would find it in their heart to do that for you.
Yeah. And I'll throw in a little aside here. I'm going to step aside that with this, since it's our webinar, Credit Safe. One of the things that can help with that discretionary limit for you is to be using something like Credit Safe. And FYI, a lot of these insurers are actually using this data, which just means the more trade payment data you're contributing and working with us on, the better they're informed and the more stuff's out there and the better information that's out there. So, again, that exchange of data, like you were talking about, helps everybody to make those decisions a lot better. So now just kind of jumping back into it. And this goes along with kind of the credit decision-making process you were talking about. They asked, what is the procedure that insurers want to see for granting credit? So is there a magic formula for that? Is there a magic procedure they want to see?
Well, no, there is no single way. I mean, look at it this way. You got either a customer who you've never extended credit to before, either because they're a brand new customer or they're someone you've had on cash in advance up till now, and now you want to start giving them credit, or it's a company that you have experience giving them credit already. If it's someone you've never given credit to before, an insurance company is either going to look at how you do this already. What information do you gather on customers? Credit safe credit reports, trade references, financial statements, whatever you do, that may be good enough for the insurance company. They say, fine, keep doing what you're doing. That works for us. If you've already been selling to a customer, what's equally important is what's your ledger experience? How well are they paying you? And many insurance policies will grant discretionary credit limit rights or make credit decisions, where the insurance company is making the credit decision based solely on ledger experience. Plenty of policies are set up that say, for example, look, if you've already given credit to a company and they've paid you good over the past 12 months, and being paid good typically means not more than 60 days slow or 90 days slow. So these are fairly generous definitions of prompt payment. If you've been paid good, then you can double what you gave the company, your customer last time, and it's covered. Now that would be up to some discretionary limit. So say your policy had a discretionary credit limit of $200,000. If you'd given a customer once $25,000 and they paid you good, now you could simply go to 50 on the basis of that one good payment experience. And that's all you need to have to be covered. And when they pay you good on 50, you could go to 100 and so on up to that discretionary credit level. And you can do that with however many customers. So it's really a combination. It's the conventional credit information, credit reports, financial statements, trade references, that kind of thing, and also your own experience. There's no single magic, scoring mechanism for how, what insurance companies are looking for. And again, it really varies from industry to industry.
Yeah. Great stuff. Last question here that I have, folks. I mean, we still have a couple of minutes left, not a whole lot. So if you want to get in there, please throw these questions in there. With the possible surge of claims, is it better to adjust terms more than trying to make a claim? And how do I get the insurer to agree?
Wow.
Multi-part there. It kind of covers your whole webinar.
I'm assuming by adjusting terms, the surge in claims doesn't have anything to do with it. That's the insurance company's problem, not your problem. You bought an insurance policy, says you're going to be indemnified if this or that happens. You have every right to expect that you're going to be indemnified, and you should be. A surge in claims may have an impact on the credit insurance industry in the long run, But look, it's cyclical. You have 7, 8 good years, and then you have a bad year, and you got to deal with that because that's, you take the long view. But as far as the specifics of a particular claim, again, if you're thinking about accelerating payment terms or rescheduling and pushing payment terms out farther with a company that you've got insurance on already, that shouldn't necessarily be driven by the insurance. As we don't want the tail to wag the dog here. It's more to do with your relationship with your customer, what you think is cogent and makes sense for your company. So if you think it's a good idea to move up or move back the payment with the customer, that's fine. You should think about that. That kind of thing goes on all the time, reschedulings and so on. But you got to talk to the insurance company first. You cannot make that call on your own because the insurance company, it's not like they want to interfere with how you do business in general. But in this case, the insurance company agreed to insure you for doing business on certain payment terms. And now you're changing those. And you can only do that and still be covered if they bless it. But if it's a good story, there isn't a reason why they wouldn't.
Okay. And I'm going to ask a follow-up personally, just from a host view here. Is there a procedure or something that is defined for most credit insurers that they're going to let you know ahead of time, hey, if something happens and they do need to adjust terms and you feel it's reasonable, as long as you do X, Y, and Z with us, then we can fairly evaluate that? Or is it just kind of a case by case?
Because, bad debt losses happen in so many different ways, and you don't know up front. Companies really worry. It's like anything that people worry about. They're all worried about getting struck by lightning, and then this is what's going to get them coming out of left field.
Right.
It's the same thing here. Companies say, I'm really worried about this and this, and when they end up coming into us with a loss and a claim filing, it's something they never saw coming, which is kind of the whole point with why you got the insurance. If you knew who was going to burn you and how, you wouldn't get insurance. You just wouldn't sell to that guy.
Right.
No, now to get a little more in the weeds,
sure.
Most policies do come with a feature that automatically will allow the insured party to give an extra 30 days or an extra 60 days in unique circumstances, which is spelled out. It says, if your customer just wants another 30 days, if these conditions are met, you can just give them the extra 30 without having to come to us. But that's pretty minor. We're talking about a fairly short amount of time. And usually if you're talking about a rescheduling, it's a bigger deal. A customer is looking not just for an extra 30 days to pay, but they're looking for, they want to take what's due in a month and spread it out over the next 6 months or something like that. It's usually something much more drastic.
Sure. Absolutely. Well, that is all the questions, Gary. I want to thank you on behalf of our audience and behalf of CreditSafe for joining us for these last 2 webinars. It's been great talking with you. Everybody that's joined us today, thank you so much. And anybody that's watching on the recordings, thank you for watching this as well. Our next webinar will be in a couple of weeks. We're going to take the week of Thanksgiving off. So everybody enjoy their U.S. Thanksgiving holiday. And our next webinar is on Thursday, the 3rd of December, same time, 2 p.m. Eastern, 11 a.m. Pacific. And I'll be talking to Steve Carpenter, who's the managing director of CreditSafe Canada, about all the stuff going on in Canada right now and the opportunities and everything that are available there. So from Gary, for Meridian, for CreditSafe, and for myself, Nathan, I appreciate y'all being here. Have a great holiday next week if you're in the U.S. And we'll see you next time, guys. Thank you.
Good luck out there.